Hello guys, welcome back once again to the Financial Academy YouTube channel. Yes, of course. Welcome back once again to my YouTube channel. So in today's video episode, I'm gonna be teaching you how to identify forex trend reversal. Yes, of course. In today's video episode, I'm gonna be teaching you and break down for you on how to identify a forex trend reversal. This very video is very important. As someone who is trading the financial market, you need to know and learn on how to identify a forex trend reversal. So please make sure to stick with me in this video. Watch this video from the beginning to the end. Are you getting my point? Like this video, subscribe to my YouTube channel, and also comment down below if you have any single question concerning this video. Are you getting me? Without any further ado, and without wasting much of our time, I will take you over to my screen. You understand? When I take you to my screen, I'll be able to break down for you everything you need to know on how to spot forex trend reversal in the market. Are you getting me? So if you are watching this video for the first time, in this channel, I teach everything concerning the forex market, the stock market, and the cryptocurrency market. Basically, the world of financial trading. Are you getting me? So follow me right now. Let's head over to my screen. I'll be able to break down everything you need to know and learn. Are you getting me? Let's go. Let's go. Let's go. Let's go.
Hello guys, welcome back once again to my screen. Let's continue from where we stopped. The ultimate guide to identifying forex trend reversal. Yes, of course. So this introduction is all about the art of spotting the turn in the forex market. So let's continue. In the dynamic world of forex trading, trends are your best friend until they reverse. A trend reversal marks a significant shift in the market sentiment, where buying pressure gives you the way to selling in an uptrend, and also selling pressure yield to buying in a downtrend. Identifying these turning points earlier can mean the difference between capturing a new trend at its conception and watching your profit evaporate. This comprehensive guide will walk you through everything you need to know about spotting forex trend reversal, from foundational concepts to advanced techniques. Number one is this, chapter 1 is this: understanding market structure. Before identifying reversals, you must understand what constitutes a trend. What is a trend? A trend will constitute uptrend, which is a series of higher high and higher low. Then downtrend consists a series of lower high and lower low. Then sideways or ranging market, neither clear high nor lows, progressing in one direction. A reversal occurs when this pattern structure breaks. An uptrend reverses when it fails to make a new higher high and instead creates a higher low followed by a lower low. This opposite occurs for downtrend. Chapter 2 is key reversal pattern on price charts. Price action often provides the earliest clues through recognizable patterns. One is this: double and triple top bottom. Yes, one is double and triple top bottom. Double top or M pattern. After an uptrend, price tests a resistance level twice and fails to break higher. Confirmation comes with a break below the neckline. The low between the two peaks, which are the double bottom, which is double pattern. This is the bullish counterpart after a downtrend. Number 2 is head and shoulder. Head and shoulder top is left shoulder, which is the peak, higher head, and right shoulder, which is the lower peak. The trend reverses when price breaks below the neckline, connecting the lows. Then we have the inverse head and shoulder, which is the bullish reversal pattern at the bottom of a downtrend. Then number 3, we have grounding tops and bottom, which is the gradual curve reversal indicating a slow shift in sentiment. Then number 4, we have key reversal candles. Key reversal candles are pin bars, which are the long wick in the direction of the trend. small body against it, which shows rejection of prices. Then we have engulfing pattern, which is a candle completely engulfs the previous candle's body in the body's opposite direction. Then we have the evening star or evening star top or morning star bottom. So meaning that these are three candles pattern showing momentum shift. Then chapter 3, which is number 3, we have the role of support and resistance. Yes. So in this pattern, in this candlestick pattern, in this very topic, the role of support and resistance comes in because support is the price floor and the resistance is the price selling, and they are critical for reversal identification. I get my point right now. And how to use support and resistance, very useful in identifying a reversal pattern, in identifying reversal is number one is this: you need to have a clear break of major support in an uptrend signal with potential reversal. And also number two, you need to have a clear break of a major resistance in a downtrend signal with potential reversal. Then number three is this: the more times price have tested a level without break, the more significant it becomes. A break after a multiple test often leads to a strong move. Then what are the concepts of rule of reversal? Number one is this: once broken, support often becomes a new resistance and resistance becomes a new support. A retest of this flipped level can offer a high probability reverse entry. Chapter 4 or number 4 is momentum indicators and divergence. Indicators help confirm what price action suggests. Are you getting me? Moving average or MA, watch for price crossing key moving average level like 50 moving average, 100 moving average, or 200 period moving average. Watch for MA themselves crossing the 50 moving average. Crossing below 200 moving average is dead cross. What are the cautions you need to take? Moving averages are lagging. Use them with confirmation and not early signals. Number two is the MACD, which is the moving averages convergence divergence. Signal line cross. The MACD line crossing above or below a signal line can hint at a momentum shift. Also, zero line cross is a more significant signal of a trend change. Number three is this: the RSI, which is the relative strength index, and the stochastic oscillator. Look for overbought RSI less than 70, condition in uptrend, or oversold RSI greater than 30 in a downtrend as warning sign. The most powerful clue is divergence. The other one is understanding divergence. Regular bearish divergence, which is price makes a higher high, but the oscillator RSI or MACD makes regular bullish divergence. Price makes a lower low, but oscillator makes a higher low, suggests weakening downtrend momentum. Hidden divergence used for trend continuation is different. Focus on regular divergence for reversal. Chapter 5 is volume and market sentiment. In Forex, volume is often approximated by tick volume or seen through futures market. A potential reversal is more credible if it occurs on a high volume. A strong price move with low volume is suspect. Sentiment indicators. Extreme in retail traders sentiment. Example, 90% of traders are long, can be a strong constraint signal for a potential reversal. Chapter 6 is the multi-time frame analysis framework, or we call it the top-down analysis. These are the golden rule. Always zoom out. Yes, these are the golden rule I'm about to tell you in this video. Always zoom out. Identify the trend on a higher time frame using the daily chart or 4-hour chart to know the primary trend. Number 2 is look for reversal signal on a lower time frame. Use the 1 hour or 15-minute chart to fine-tune your entry. Number 3 is this: align your signal. The highest probability reversal occur when the higher time frame trend is exhausted and the lower time frame shows a clear reversal pattern with indicators confirmation. Let's take for example, the daily chart, which is the higher time frame, shows an uptrend hitting a major resistance level for the third time. Then the 1 hour, which is the lower time frame, then form a head and shoulder pattern with reversal bearish divergence. This is a powerful confluence. Number 7 or chapter 7 is a step-by-step checklist for identifying a reversal. Number 1 is context is king. Is the pair in a strong mature trend? Reversals are more likely after extreme moves. Number 2 is find a key level. Is price approaching a major historical support or resistance? A psychological level like 1.200 or a key Fibonacci retracement level like 61.8 or 78.6 is very, very important. Look for price action warning. Are there reversal candlestick pattern? For example, pin bar, engulfing or sharp pattern, head and shoulder forming. Number 4 is check momentum. Is there divergence on the RSI or MACD? Is the momentum fading as price test in the level? Number 5 is wait for confirmation. Do not anticipate. Wait for the break of a trend line or a key swing point. Example, a lower low in an uptrend. Number 6 is seek confluence. The more factors from the list above that align, the stronger the potential reversal signal. Number 8 is this, which is chapter 8, is risk management, which is the non-negotiable element. Yes, identifying a reversal is only the half battle. Managing the risk of being wrong is the other one. Place stops wisely. Your stop loss should be placed beyond the level that would invalidate your reversal hypothesis. Example, above the right shoulder in a head and shoulder short. Beware of false breakout or reversals. Markets often fake out traders. Are you getting me? Use closing prices, especially on a higher time frame, for confirmation, not just intra-candle breaks. The other one is position size. Trade smaller when playing reversal, as they are statistically more challenging to catch them than trend continuation. In conclusion, patience and practice. Identifying forex trend reversal is a skill, not a perfect science. It requires patience to wait for high confluence setup and the discipline to follow your trading plan. Start by observing charts in reply mode, marking historical reversal, and noting what conditions precede them. Perpetuate your ideas before risking your rare capital. Remember, the goal is not to catch the absolute top or bottom, but to capture a significant portion of a new trend once it has been reasonably confirmed. By combining price action, key levels, indicator confirmation, and multi-time frame analysis or top-down analysis, you equip yourself with a robust toolkit to navigate the ever-turning seas of the forex market. So my final pro tip is this: when in doubt, stay out. It is better to miss a reversal than to force a trade and be caught fighting the prevailing trend. The market will always offer another opportunity. That's the true sort of all this thing. The market will always offer you another opportunity whenever you're in trading. So make sure to always know when to stay out of the market. Don't force a trade. No. Allow a trade to come to you. Then you trade. Wait for the market to first of all drop a blueprint or drop a footprint. Then you follow the blueprint. Don't rush the market. Don't force yourself into a trade. And like I always say, always apply proper risk management. Always follow your rules in trading. And also, always be disciplined and patient. Control your emotion whenever you are trading. So this is my final advice in this video. If you have watched this video up to this moment, please make sure to like this video, make sure to subscribe to my YouTube channel, and also comment down below if you have any single question concerning any of my videos. And I will see you on my next video episode. Please take care, stay safe, and bye for now.